Markets in the red today, despite the U.S. president finally nominating Kevin Warsh as the next Federal Reserve chair. He is expected to lower interest rates, or at least support that in the short term. Let's go to Scott Wren, senior global market strategist at Wells Fargo Investment Institute. Scott, thanks for joining us today.
Good afternoon.
So investors seem to like this pick by Donald Trump for the chair, but they are reversing course in a big way on precious metals. Why the retreat?
Well, I think that for one thing, precious metals have obviously had just a huge run. And I think the market's still really debating. If you go back to when Kevin Warsh was a Fed governor, he was more on the hawkish side. And so I think he has, certainly come over toward President Trump's view that interest rates need to be lowered. I think it was more of an excuse that, well, maybe this isn't going to be as easy as we thought if, Kevin Hassard or somebody like that was nominated. So I think it's with the precious metals, it's mainly a situation where, the dollar's stronger, precious metals are down, and maybe the Fed's not going to be quite as dovish as some people had thought. That could be just the excuse, though, for the day. Okay,
that's true. We won't know till Monday. Let's turn our attention to big tech, because there's still clearly an overhang for investors. Apple, big bump from iPhone sales, record sales for that, but the stock is down. So what's going on?
Yeah, I think, it's a similar thing, really, to be honest with you, as precious metals, where you've had such a run in these stocks. And granted, we've seen a broadening market. On a year-to-date basis, Infotech had trailed. But I think that the Mag 7 is certainly going to participate this year. But we think that in terms of prices that take the S&P higher, in terms of earnings, you're going to see broader participation from a number of other different sectors. We actually are back down to even weight on tech and communication services. And the sectors we're overweight in right now are financials, industrials, and utilities. So we want to keep that AI theme, but we want to look at some other sectors that are going to benefit as all this CapEx spending and AI benefits kind of trickle down through the economy.
Okay, so we've seen the beginning of some of these big tech companies report. You think it'll be the same next week when we hear from others? And
I do. I think, it's kind of funny because all last year, and obviously, this is the fourth quarter we're hearing about now. All last year, the market was a little bit nervous about these companies backing off of their AI CapEx plans, and all they did really was just tell us every quarter that they were going to increase it. And so they're still going to spend a lot of money. But of course, the market's starting to turn around. They're going, okay, the spending's big. When are we going to see some results here? When is this going to drop to the bottom line and boost EPS? And, you hear companies like Meta say that, this year they're going to spend $115 to $130 billion on AI infrastructure. I mean, that is a huge number from one company. And so I think the market does want to see some results. It's cut these companies some slack. But this year, and probably particularly next year, the market's going to want to see some earnings on the bottom line. They want a return on investment for all this money that's being spent.
Okay. You favor the large and mid caps right now. I know small caps have had a bit of a comeback over the last month or two, but why aren't you looking at small? Why are you remaining in large and mid?
We had been underweight smalls for a while, and that worked pretty well. And they performed a lot better last year, really, than what we thought they would. And we've stuck with that quality theme. So that's a vague term, but for us, it means good balance sheets, lots of cash flow, lots of products, easy access to credit. They're buying back shares. That's not really where Russell 2000 stocks are, if I generalize a bit. So I think normally in a cycle, when you would have been coming out of a recession or a meaningful slowdown where earnings contracted and the economy was very slow, people want to take more risk. Monetary policy is usually pretty effective, and small caps outperform for the first couple of years in the cycle. But this time we really didn't have much of a slowdown. I think that what really fired up small cap stocks was just the thought that the Federal Reserve was going to lower interest rates more than they probably will. So, last year, I think, and really the last few months, I think that was more of an aberration. And I think when 2026 is all over and done, large and mid caps are going to outperform smalls this year.
Okay. What are you doing with fixed income right now?
Well, fixed income, we've been stuck in that 3 to 7 year maturity. That's the maturity range that we like. Technically, we're underweight the short end of the curve. We think the Fed is going to cut a couple of times this year. And then we think long rates are probably going to rise a little bit, not a lot. So we've also been underweight the long end. So we like that 3 to 7 year maturity. And once again, it's kind of quality. It's investment grade corporates. It's essential munis. Things like that. So we're still on that quality, dependability type of theme that we've really been on for a couple of years now.
Okay, Scott, I'm going to leave it there. I'm out of time. Scott Wren is a senior global market strategist, Wells Fargo Investment Institute. Thank you, sir.